Hi, welcome to The Spread, JLN's take on the week's notable news from the options world. I'm Spencer, doing the heavy lifting so you don't have to. $200 million. Some companies dream of numbers like that in annual reports, but $200 million in this case represents what Goldman's Flow Derivatives Group made in one day, February 5th. That's about what Goldman's derivatives unit historically makes in a year. Now, on the flip side of that coin, LJM's disastrous losses in February. This week, there was a great autopsy of the fund out on RCM Alternatives blog. Pretty much, LJM's historical performance is in line with the old pennies in front of a steamroller chestnut. Lots of small wins with the risk of less frequent but huge losses. And the track record shows this. The fund lost nearly 50% in 2008 and more than 40% in August of 2011. Now, the piece skewers the fund's concept of risk management, or, well, lack of risk management. And sure, their positions didn't actually go into the money, but they were leveraged out the wazoo, and it was the margin call that did them in. If they'd made it past early February, well, the firm likely wouldn't have realized nearly as much of those losses. Needless to say, LJM is a bit miffed at their brokerage. Now, LJM might be closing up, but Citadel sure isn't. News broke that Citadel Securities was setting out on a growth push, upping the ante in its market-making endeavors across all sorts of asset classes, including options. So this is great news for markets. And I specifically mean Chicago and South Florida real estate markets, because when Mr. Griffin does well, he buys property. Now, firms like Citadel have benefited from post-financial crisis rules as banks retreated from classic liquidity-providing roles. But that pendulum could be swinging back the other way as this week. Not only did Washington push a revamp of Dodd-Frank through, but reports surfaced that when the Fed meets on May 30th, they will likely look favorably upon a streamlined version of the Volcker Rule, which limits banks' prop trading. Now, basically, the revamp will likely redefine what a legitimate hedge is. Currently, the rule is super complicated by the assumption that trades of less than 60 days are automatically proprietary moves. There's a great quote in the Financial Times' piece from an unnamed lawyer, quote, "The Volcker Rule is like using an entire army to stop a neighborhood bar fight, and understanding its complexity is almost beyond the capacity of the human cortex." Now, that's a great turn of phrase, but I'm guessing the lawyer didn't want to be named since admitting it's super hard to understand probably undercuts the $1,000 an hour asking price for the person's legal work. Another area of the market still dealing with what regulation means for its future, the digital asset crypto token space. Now, why is that relevant? Well, Overstock's T0 unit and Box Options announced that they were teaming up for a securities token exchange this week. Now, it feels like the question for exchanges now is not, are you working on a crypto endeavor, but what crypto endeavor are you working on? Anyway, I'm thanking the heavens I can finally wear the same short sleeve shirt that I wore on Amelia Island. Hope everybody in the States enjoyed or is in the middle of enjoying a beautiful holiday weekend and some grilling. Now, I'll have you know that Clorox stock, Clorox owns Kingsford Charcoal, rallied some 4% heading into this grill-related holiday weekend. Now, is that a coincidence? Well, yeah, probably. Have a good one.